SMCI, the AI server darling, but the margins are screaming. Super Microcomputer fell 5% yesterday after Goldman Sachs reiterated a sell and a $26 price target, not a fresh take, just the same cautious drumbeat we've heard before. Yet the company says it's running at massive scale, $36 billion revenue guidance, giant NVIDIA Blackwell order backlogs, and rapidly growing server market share. So which story wins, the growth story or the margin squeeze? Goldman's Catherine Murphy and team has been a skeptic on SMCI for a while. Their latest note reiterated a sell rating and cut the price target to $26, arguing that while Supermicro is well positioned for AI server demand, the economics look worse than before, mainly because the company seems to be sacrificing margin to win share. In Goldman's view, server designs have standardized, competition is intense, and customers increasingly force pricing leverage. So even if SMCI books $36 billion of revenue, Goldman asks, how much profit will actually fall through? Why this matters: big name sell calls produce headlines and algorithmic flows, retail traders see the headline and many bid to sell immediately. That's why a reiteration from Goldman still moves the tape even if it's the same view they've held for months. Think of Goldman as the cautious lifeguard whispering, "Rip current," while the party crowd is already in the surf. Same warning, same risk, but the surfers still might ride the wave. The bull case: orders, market share, and $36 billion ambition. On the bullish side, the facts are dramatic. Management has said it expects record orders and has guided to an enormous revenue target, roughly $36 billion for fiscal 2026, which is an order of magnitude larger than a few years ago. The company reported a multi-billion backlog tied to NVIDIA Blackwell Ultra GPUs and said many orders are now booked. Reuters and other outlets confirmed the backlog details and the revenue ramp expectations. Add to that the market share story. SMCI has publicly said its share of relevant server markets rose from the low single digits in 2021 to the low to mid-20s today, and independent analysis also shows large share gains. In some segments, Tier 2 cloud providers and neo-cloud build-outs, SMCI is a dominant supplier. That's not a small, tactical win, it's a structural footprint that can create years of revenue. Imagine a regional pizza chain that suddenly wins franchise deals across dozens of new cities and gets a multi-year supply contract with a national delivery platform. Revenue explodes, but the question becomes whether the new stores will be profitable once you staff, equip, and promote them. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. The margin problem: why Goldman and others worry. Here's the heart of the debate. SMCI can grow revenue spectacularly. Analysts and management expect huge top-line expansion. But that growth has not translated into proportional earnings growth. Wall Street numbers show a big year-over-year revenue jump. Management and some consensus estimates point to 65% growth this fiscal year, and yet EPS has been sticky, not increasing as much as revenue. That happens when margins compress. Supermicro's own financials show the margin slide. The company reported quarter gross margins around 9.5% in Q4 FY 2025, and FY 2025 gross margin declined to 11.1%, well below earlier peaks. Operating margins have also been squeezed. Goldman stresses that competition, rising input costs, memory, components, and customer bargaining power in a standardized server market all push margins lower. If SMCI is aggressively pricing to win share, profits will lag. You sell handcrafted coffee at $5 and make $2 profit. Suddenly a competitor opens selling the same latte at $4 to win customers, you drop your price to keep market share. Revenue picks up but profit per cup collapses. Now multiply that across tens of thousands of racks. How can revenue grow 65% while EPS stalls? The mechanics. There are three big reasons revenue growth might not lift EPS immediately: lower gross margins. If SMCI is selling a higher proportion of low-margin systems or giving price concessions, gross profit per dollar falls. That's the clearest explanation when gross margin drops from 15 to 18% down to single digits. Upfront investments and capex. To support a $36 billion revenue run rate, SMCI needs working capital, more manufacturing capacity, and possibly inventory builds, all of which can depress free cash flow in the short run. The company's new $2 billion revolving facility shows it's preparing for that. Order timing and revenue deferrals. As the company itself said after a previous quarter, some orders were delayed into the following quarter due to late customer configuration changes. That can distort quarter-to-quarter EPS flow. Reuters covered earlier deferred revenue of about $1.5 billion due to integration delays. So revenue growth is necessary but not sufficient. Margins and timing determine the profit punchline. Market share, from 3.5% to 22 to 27%. Is that real? Management and multiple industry trackers show SMCI's server market share soared from a niche player in 2021, 3-4%, to the low to mid-20s in recent quarters in certain server segments. That's huge. Winning a couple of percentage points in a multi-billion market is hard. Going from 3% to 22 to 27% in a few years suggests real product, pricing, and operational advantages. Why that's important: share gains at scale compound. If the overall server market grows at 12 to 15% annually and SMCI is capturing market share faster, that could move it to 3.3x, the company can multiply revenue without necessarily needing extraordinary multiple expansion, but profitability still needs to be proven. Picture a food truck that turns into dozens of brick-and-mortar restaurants across many cities over a few years. The revenue base explodes, but the work of maintaining uniform quality and costs at scale is non-trivial. The financing move, $2 billion revolver, why it helps. To fund surging orders and inventory, SMCI secured a $2 billion revolving credit facility. That reduces the risk of short-term cash crunches while the company builds out manufacturing lines and pre-purchases high-dollar components, like GPUs and high-bandwidth memory. In short, it gives management more flexibility to deliver at hyperscaler speed. But financing doesn't fix margins, it just prevents a liquidity crunch while the margin story evolves. If SMCI can use that capital to execute faster and capture more high-margin, sticky deals, e.g., service contracts, the financing could be accretive. If not, it just enables a prolonged low-margin pivot. Note this as well. It is written in Revelation 14 verse 7 that, "Fear God, and give glory to Him, for the hour of His judgment is come, and worship Him that made heaven, and earth, and the sea, and the fountains of waters." I appeal to you to fear God and obey His law. For His commandments are sure and His word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.